Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Remember, like, subscribe, comment, ask questions. We want to get this stuff passed around so more people learn about options. All right, stocks finishing fairly unchanged yesterday. So the big number, CPI, everyone had their eyes on, came out. And they were fairly in line, to be fair. Market kind of digested it by just chopping around, not really going too far. We did fade off the intraday highs before the number, but then the option market dynamics did provide some support, which we'll talk about in a bit in more detail. So the S&P couldn't really break materially below 4,100 and managed to pretty much rally back to unchanged, right, which is about 41.36. Commodities also found a bit of support, although they do seem to be fading a bit overnight as Asia was weak and the dollar is kind of grinding back higher. Volatility wise, obviously pretty predictable that vol was going to get slammed. We had flagged that. We saw a good vol reset here in terms of US markets, but in general, we're seeing vol lower all across the board. Even in commodities, vol's got slammed as well. VIX back onto an 18 handle, has popped a little bit overnight again, but I wouldn't necessarily expect that to persist. I'm still in the camp. The VIX could have materially more downside over the course of the next sort of 4 to 6 weeks. Implied vols obviously got crushed, making this carry kind of go more negative. So basically, realized vol to some extent is lagging, it's backward looking. Implied vol is forward looking. So when implied vol gets slammed and realized vol still has historic numbers in it, it looks like, oh, this is a screaming buy. We've got negative carry, so you should be long every option under the sun. Doesn't necessarily work like that, right? When you get these type of events and these vol resets, that vol reset is basically forward looking and it's saying we now anticipate vol to come down. We think the forward looking realized is going to come down, and therefore this flip towards negative carry across all these indices is likely to be short lived if the market does find stability and realized numbers start to come down. And that's what I anticipate probably will happen over coming days and weeks. Commodities are also mostly still in flat to negative carry, which basically says that implied vols have come down pretty significantly over the course of the last month in commodities, making commodity vol look relatively good value now. So that's kind of my takeaway there. In terms of skew, we did see softer skew in most of the places, Europe, US, but NASDAQ skew did catch a little bit of a bid for some reason, probably just flow related. We also saw Nikkei skew down quite heavily. That's down to like pretty much the lows. So something to watch out for there. Obviously, dollar yen's been rallying a little bit on the back of what's going on with the Bank of Japan and the next governor, etc. So maybe an opportunity there if you did think that was a fade to pick up some downside in Nikkei. And then within commodity space, we did see a pullback from the extreme high of the nat gas skew, down about 4 vols there in the 91. In the 25 delta risk reversal. We also saw a bit of a bid come back for uranium and for gold miners skew. Okay, so that's kind of where we are. Looking at the terminal rates pushing higher. So the market, we had those numbers, a bit for everyone in those inflation numbers, but in general, nothing significantly away from expectations. But the market reaction really is kind of what you want to gauge, what the market takeaway is from that. And basically stickier inflation in the core services ex shelter, which kind of Powell's preferred measure of inflation now, that re-accelerating on a 3-month annualized basis keeps pressure on the Fed to stay higher for longer. The rates market has started to price out some of the late 2023 cuts that were priced into the curve, but it's not just pricing those cuts and just taking them completely out of the game. What it's essentially doing is saying, well, the cuts don't come necessarily as soon as we thought they were, higher for longer, but then when the cuts come, the cuts may need to be, quick. And that's why the curve is actually inverting. So whilst you're taking cuts out of late 2023, the yield curve inversion in the 2s, 10s is actually pushing to new extremes of around 86 basis points negative. Okay, so markets think that higher for longer means a worse recession later on, and hence the need for steeper rate cuts once the pivot eventually happens, even if that pivot is delayed. Terminal rates did push up to around 5.3%, but have faded back slightly overnight. You can see that in the chart there, back to 5.25%. The core goods inflation, which has fallen sharply in recent months, seems to be stabilizing, which does remove a disinflationary tailwind, as our friend Macro Alf points out in his latest piece. We've got the chart there. Retail sales are the next data point that market's going to be watching today, But bear in mind that they could be quite noisy. January, seasonal adjustments, things like that. So not sure the market's going to have that meaningful a reaction to it, but expect some noise as we have been seeing. Intraday noise seems to be rising, and that's kind of being exacerbated by some of these zero DTE option flows, as we discussed with our good friend Brent at Spot Gamma in the YouTube live yesterday. Okay, now lastly, if we jump over to the VIX, similar kind of story. VIX getting slammed, similar to the fixed right surface getting slammed as the markets were relatively unchanged. So we saw VVIX and VIX both falling sharply on the back of, after the event came out. We have got the VIX expiration this morning. Whether that's an upprint or a downprint really depends on what the likes of Goldman's, JP, and Morgan Stanley want to do with the print. So I don't really try to predict that. So I very rarely, even if I've got a VIX position, do I run it into the print, because I think the print's notoriously hard to predict. But if we look at what it looks like, the landscape in VIX options outside of February, and we've taken February out of the game. So the front expiry is now March. You can see these big blocks of call options building in the 24 up to 30 strike area. That's where the hedging flow has been. Quite large clips of 250,000 options. So we can see a fair amount of convexity being taken out of the market if the VIX was to go above 25. So that might create some instability if the VIX was to find a reason to go back to 25. If you see those big white bars, that's actually June as well. So we're seeing June options in the 30 strike and the 40 strike printing on the upside as well. So some people are feeling the need to put structural VIX upside positions on in both March and in June expiry. Okay. Now, me personally, I do think the VIX is likely to head lower over the course of Q1. I'm looking for a 16 handle to be reached at some point in the next 4 to 6 weeks. If we get there, then I will likely look for upside plays and see if you can put on something like call spreads that makes sense to play a VIX spike later on in the year. Maybe around May, June time will be the first sort of expiries I'll be looking at. And then lastly, just to flag, in terms of trades, we did flag these 20 puts on VIX to the 22nd February, which is next Friday. They were worth around 35, 40 cents on Monday when we mentioned them. They've pretty much doubled in value in 2 days. So worked out well for those who managed to get them on the books. I'd probably still hold on to them, to be honest. Like I say, I do think, gun to my head, we probably continue to see a grind higher in spot and lower in VIX. But if you've doubled your money on those, then a good risk management play is always to let half of them go and free ride on the balance, basically, right? So these are the type of things you can think about in terms of actually executing positions and risk managing positions. All right, that's it for today. Thanks a lot for listening, everyone. I'll catch you guys tomorrow. Cheers.